Pay. Lucian Bebchuk, he's director of the program on corporate governance at Harvard Law School. Good morning to you, Professor. In looking at your position paper here, it looks as if you do believe that the current executive pay structure contributed, if not led, to the financial crisis that we're in.
Right. I mean, that's something that Jesse Fried and I warned about 5 years ago in a book called Pay Without Performance. We warned that the ability of executives to unload incentives, equity incentives in the short run, provides perverse incentives. Now, in the aftermath of the financial crisis, this is widely recognized, including by business leaders, and therefore we hope that this is going to change.
Well, you are suggesting that pay be linked to performance of a company's stock price or performance of corporate bonds. What are you suggesting here?
I think that there are two important elements. One is we need to make sure that executives do not receive rewards for short-term results that might later on be reversed, because we know that this can provide incentives for excessive risk-taking. So we need, first of all, to tie compensation, both bonus compensation and equity compensation, only to long-term results, and there are ways to do it. For some financial firms, we might consider, again, to provide appropriate incentives with respect to risk-taking, to tie compensation not just to equity values, but to other parts of the capital structures, like bonds.
Well, critics would say that the reason that executives were rewarded for a certain level of risk-taking, if you want to characterize it as that, is because that's what Wall Street was looking for. Risk-taking led to higher corporate results, thus the street rewarded that with a higher share price. So in some ways, how do you mitigate that need for a certain amount of risk-taking with the idea of sort of offsetting the amount of leverage that a company can take on? I mean, how do you find that middle ground of safety while still rewarding shareholders?
I think that if we tie compensation to long-term results, we will exactly
what's long-term
tie
results?
the interest.
What do you mean by that?
To long-term results, it means that people should not make profits if the stock price goes up in the short run, but not in the long run.
So at the end of a quarter, you would look at the percentage of like profit growth? I mean, what's the metric that you think is sort of best to look at there when you say long-term results?
Right. So if we use equity incentives, we need to provide them with shares and options that cannot be unloaded quickly. They will have to keep those shares and options for an extended period of time, like 3 years or so, after those shares and options are vested, and therefore they will focus on the share price 3 years down the road rather than the share price at the end of the quarter. With respect to bonus compensation, what we need to do is to use metrics that focus on a long period, not on a quarter, but on 2 or 3 years. And moreover, we should place bonuses in a company account, not enable employees to cash them right away, but park them in a company account. And if it turns out after a year that the basis doesn't hold up anymore, those amounts will be adjusted.
All right. Thank you so much, Professor Lucian Bebchuk, joining us live from Harvard University.